Good afternoon, everyone, and welcome to this webinar. My name is Gail Mercer, and I will be your instructor for today. And today we're going to actually go through understanding high gamma strategies in binary options. Now, before we get started, I would like everyone to take a few moments to read over the disclaimer. And basically, it states that trading is risky and you should never trade with money you cannot afford to lose. Okay? And, any type of trading, even binary options, does have risk associated with it. And you have to be able to accept that risk. If you cannot, then you should not be trading. Now, for those of you that do not know me, my name is Gail Mercer. I've been trading for about 15 years, and I started out with a company that programmed technical analysis indicators for the market. I became so enticed with the price bar that I decided I wanted to be a trader. I do specialize in price action, volume analysis, and divergence because I believe they are leading indicators. I'm also a frequent contributor to Stocks and Commodities, Traders World, and Top Shelf magazine. I've also been a speaker at Traders Expo, Traders World Online Expo, and the Wyckoff Volume Conference. I'm also the author of Trading Nadex Binary Options, Keeping It Simple Strategies, and I have a new book coming out in about 2 weeks that deal with both binary options and spreads. Now, what is gamma? Now, there is a very technical explanation for gamma, but I want to keep this very simple because we do have a lot of traders that are new, and I don't want to scare you away with a complicated definition. So let's look at the simple definition of gamma. And it actually refers to how fast price is changing from one strike level to the next. And it also increases when there are less strike prices available. For example, 5 strikes versus 2 or 3 strikes. Your gamma will be different. High gamma trades can be riskier because the markets are moving slower and there's less possibility for the price to expire in the money. They work best if you use a leading indicator or methodology to identify a momentum move. For example, if a market is overbought or oversold, and you're expecting it to reverse, that would be a good example of using a technique with high gamma trades. Also remember that your job as a trader is taking profits, not necessarily staying in until expiration. Normally when I'm trading the high gamma trades, I don't stay in until expiration. Now, what are high gamma trades? They can be easily identified by looking at the premiums for the available strikes. The higher the premium price difference, the higher the gamma. The higher the gamma, the quicker the premium moves in your favor, as long as the underlying is moving in your favor. Now, on this example, I want you to notice the difference in the strike prices. And it doesn't matter whether you're looking at the sell or the buy. But notice that on the buy side, you're about $9 to $10 difference on each of the strikes. Okay? This is just your typical gamma. Okay? Typical gamma is usually around $10, can be as low as $5, okay? So that would be your typical gamma. All right, let's look at a high gamma example. This is a high gamma, And if you're looking at the differences between these prices, I mean, you know, some of them are $20 and $30 between the different prices. These would be high gamma. And notice, really, you're only trading about 3 strikes here. That's typical for the high gamma setups, okay? And this is very visual, so it's very easy to identify when you have a high gamma situation. All right? At the money is always going to be just about $50 of risk. Now, it could be 55, it could be 45, but generally it's around that $50 range. If you're using a high gamma, typically you're going out of the money, and typically your risk is going to be $35 or less, okay? It's not something that you're going to risk $50 on. Okay, so for example, if you were to buy the Euro British Pound 12 to 2 p.m., you're buying the 85.66 strike, you've got $34.25 of risk. Now notice that you've got an hour and 42 minutes until expiration, and you're going in the strike, and the risk is less than $35, okay? Now, the next question that you'll have to answer is, can the strike, the price, move as far as the strike is? In this case, you've got a strike at 85.66, price is at 85.59, so you need really about a 7-pip move, okay? So the question becomes, can the Euro British Pound move 7 pips in an hour and 42 minutes? Typically it can, so you would be able to take that if the criteria for your entry is valid. Now in this case, you can see that it did move very quickly in your favor. It's now at 85.68, so you had a very small movement, okay? It was, you know, about 8 pips, but the value has increased to 22.50, okay? That's a high gamma move. It didn't have to move a lot to give you a profit, okay? Now, here's, whoop, wrong way. Here is another example, and I believe this was from yesterday, okay? Now, the risk on this one, and I'm going to show you the actual strike at 76.76. It was on the Aussie dollar, and it was 3 p.m. to 5 p.m., okay? The risk on this was 31.50, okay? It moved from about 76.78 down to 76.74. That was basically a 4-pip move, but you can see the value of that move is already at 24.50, okay? Then it continues down, and you have a value here of 40.75. Now comes the important question. Should you hold until expiration, or should you exit the trade? And what I try to do is calculate the time factor and the remaining profit, okay? So you've got 37 minutes left. You got $27 of profit still remaining, okay? You've been in this, I think, about 30 minutes, okay? So if I exit right now, I have made about $2.54 per minute, okay? If I hold until expiration, my time value, because your time is valuable, goes down in price to $129. Now, I don't know of very many traders that would want to decrease their wages, and that's what you're doing. in this scenario, if I exit right now, the time value, which is my time, is equal to 254. But if I hold, I'm decreasing the value on my time. Okay? So I don't want to do that, so I just go ahead and exit. Notice that on entry, your risk was $31.50. You've been able to capture $40.75. So you still made a nice profit. Just go ahead and exit. Now, gamma is typically higher on the slower markets. For example, trade the off hours of the currencies. You know, the euro British pound is an excellent one to do because that typically moves during the London session. So during the U.S. session, you're going to have a higher gamma. The British pound dollar, the euro dollar, USD Canadian, USD Swiss franc, all of those during Asia typically will have a high gamma on them. Now, you can always contact me at gm@tradershelpdesk.com. You can call me on my cell phone at 336-263-0122. You can visit my website at tradershelpdesk.com or go to the blog, which has a ton of information on it, at blog.tradershelpdesk. Now let's go see if we can just identify some high gamma trades for this afternoon. And let me bring up Nadex. So right now it's about 12 o'clock in the afternoon, and we're going to look at, let's look at the euro British pound first. And we'll go and look at the 1 p.m. Typically, I won't, you know, about an hour and a half on my high gamma, but we'll look at this and see what it's doing. Okay, you can see there's predominantly two strikes that are being traded. Okay, you can also see that this market is to the point of being overextended. Okay. If you had a bias to the downside because the market is overbought, you could actually sell the 85.71, which is about 6 pips from where price is currently trading, or you could even go up and buy the 85.81 area. So that would be your two choices on this particular one. You've got the buy at 36. If you have a downside bias, you could sell the 85.71. Does everybody understand that one? And look at the differences between your sell prices. Look at the differences between your buy prices. Okay? On the buy side, it's almost $50 difference. Okay? So if this was to move up just a few pips, then that is a very valuable move. Okay? On the sell side, again, you're really greater than $50. Okay? So if this was to suddenly move down, that's a very valuable entry. Does everybody see that? And again, the euro British pound is not going to move a lot, okay? Not typically during the U.S. afternoon session. This one would be more prone to moving during the London session, which London actually opens at 3 o'clock Eastern time. So, you know, I wouldn't be looking for a high gamma trade during London. But during the U.S. afternoon session, hey, it's a possibility. The other one that has quite a few high gamma trades on it would be the USD Swiss franc. Let's look at the 2 p.m. expiration. And you want to make sure you expand all of your strikes out, okay? In this case, you're not seeing a lot of gamma on these because look at the difference. It's less than 20 bucks, okay? This doesn't have high gamma right now. You might try to come back, say, 3 o'clock this afternoon. Is there high gamma on it? You're not always going to get a high gamma trade. This is when you recognize it, this is when you're doing the high gamma trades. So in this case, I know this is not a high gamma trade. Don't even try it. Okay? Not for high gamma. You can trade it, you know, using another methodology, just not high gamma. Let's go look at the British pound yen. 3 p.m. This one generally, you know, this has good days and bad days. When it moves slow, it really moves slow. When it moves fast, it really moves fast. So again, this is one you want to stretch it out. Make sure you can see all of your strike prices. And again, if you look at the difference, and this is just an easy way to identify whether you've got gamma playing for you or not. Okay, here you got about $30 a difference. Here you got about 30. This could potentially be a high gamma trade. And it's got 3 hours until expiration. Again, you want to use a strategy that can capture a momentum move. Okay, in other words, right now you see that you're ticking up on the stochastics. So you're looking at this and saying, okay, it would have to move from 140.06 up to, I like to say, at least 140.21. Okay? Technically, it just has to be 21, the extra digit being the 1 over here. But I like to just round up and say 21. So can this move, you know, 15 pips in 3 hours? The British pound yen can move 20 pips within that time span, okay? Doesn't mean that it will, it just means that it can, okay? So you take a leading indicator like being overbought and oversold with a reversal bar, and then that gives you your entry for a high gamma trade. Does everybody understand? Any questions? And to me, this is very visual, so it makes it easier for you to understand. All you're doing is looking at the differences between the strike prices. I always use out-of-the-money trades in this example because you're getting the edge from the momentum move in the fact that when you have a momentum move, okay, it's telling you the direction that price is going to move. So you're just taking advantage of that and being able to capture more profits by going out of the money to lower the risk. Do you understand that? And I'm sure there are some traders that will use in the money, okay? I like to use out of the money because it lowers my risk. And you know, I did a presentation, I think last month, about using the stochastics with reversal bars. It's a great technique for using that because number one, you have a stochastics that's either overbought or oversold, combined with a reversal bar that's telling you that the next bar is going to go in a particular direction. You know, it's a great strategy for using out of the money with high gammas. Any other questions today, guys? And again, these opportunities do not present all the time, but when they do, you know, you can utilize it to actually lower your risk and capture more of the premiums. Okay, if there's no other questions today, then I'm going to end the webinar. I do hope you enjoyed it. It's a very simple technique. I think it's very easy for y'all to understand how to do it. And you just combine it with a leading strategy that tells you where the next price bar is going to go. Okay? Some of that is experience, Galena. Okay. Generally, you know, if you're doing these like on the Aussie dollar, the strike width is 5 pips. You know, that's pretty easy for that to move. Okay. Is this being recorded? Yes, it is. Okay. How do you display the strike prices? Well, I tell you what, let me shrink it up a little bit so that you can't see them all. Okay. Now, did you see how you have these little red and blue boxes over here, Chuck? All you have to do is click on them, and that will expand your strike prices. Well, you know, Nadex offers the free demo accounts. You know, this is excellent for practicing in the demo account. How do I use volume analysis as a leading indicator? Actually, divergence, the same thing. Okay. Can you use spreads for it? No. This is, you know, specifically for binary options. And Jason, I have a directional volume indicator that I use, so I can see the buyers and the sellers in each volume bar, and then I can see whether the buyers are coming in or the sellers are coming in. And you can actually see when buyers are decreasing. For example, right now on the Euro British Pound, the buyers are decreasing. In other words, as this was making new highs, the buyers were getting weaker. Okay, that would be volume divergence. Any other questions? My new book is not out yet. It will not be out for another 2 weeks. But I do have one currently on Amazon. It is Trading Nadex Binary Options, Keeping It Simple Strategies, and it's available on Amazon. I don't use a sentiment indicator per se. I have a directional volume indicator that measures the actual buyers and sellers in each individual bar.